Hi, this is Greg Goernert of Goernert Wealth Management, and this is my Insights and Perspectives podcast. Welcome to the August 15th episode of my Insights and Perspectives podcast. In this mid-month business toolkit episode, we'll be focusing on protecting your wealth, and I'll be joined by Canaccord Genuity North American technical analyst Javed Mirza.
Our view in December was that we were starting a new 4-year cycle.
It's been a wild couple of weeks in the marketplace out there, and I really wanted to get a guest in just to offer some perspective of where we kind of see the markets and where we are in the cycle right now. So I'm going to be joined today by an analyst with some great insights to where we are, where we're going, and how we're going to get there. My guest today is Javed Mirza, Canaccord Genuity technical analyst, to share his latest North American technical comment. Welcome, Javed.
Hey, Greg. Thanks for having me.
Well, hey, I appreciate you doing this. Markets have been on a pretty wild ride over the past little bit, and I know you've had some technical comments in the past, and I was just wondering if you can share your thoughts on where we are now and where we're likely to go going a little bit forward here.
Okay. So our view in December was that we were starting a new 4-year cycle with upside out into 2021, and so far that seems to be playing out. In April, we got a bit cautious on markets as they look to have gotten ahead of themselves, and so we warned clients that a correction was coming. And then in May, end of May, early June, we said that once again everything we were looking at was flagging that it was time to buy stocks. So in that time frame, we said there was an intermediate term rally with upside out into late August, early September, but it seems that tweets have fast-tracked us, and that intermediate-term correction is underway right now. So our longer-term view remains unchanged. We have longer-term upside out into 2021, but that intermediate-term correction we saw taking place at the end of August, early September is taking hold right now.
Right. So, I mean, now we're trading around 2840 on the S&P. I know you had some key technical numbers there. And also this week, the big noise in the market's been just the inversion of the 2 to 10 year treasury yield curve. How does that play into your take on the markets, and just from a technical point, and how much more of a correction do you see us having here?
Well, from what the work that Tony Dwyer, our strategist, has done is he's noted that the yield curve typically inverts anywhere from, I think, 5 to 24 months before a recession. So that still lines up quite nicely with our view that we've got upside out to 2021. So that's in terms of just highlighting or talking about the yield curve inversion. But apart from that, we look at the charts, and the charts are essentially telling us what the market participants are doing, and from our perspective, we've still got more upside. I mean, we're just pulling back from new all-time highs. You can't get any more bullish than that.
Yeah, and I think that's what a lot of people misunderstand too. They think about just how far we've come up over the past while. That correction. We've been talking about this for a year now. That it's expected and healthy going forward from here. Why don't we talk a little bit about some of your favorite places to be? I know over the past little bit the coppers got really beat up.
Yep.
What are your thoughts on that side?
So I still like it. What's happened here? Actually, let me back up a second. So what I would say is, long-term, we're in a secular bull market in equities that has upside out to 2030. Now, the last time previous secular bull markets in equities were from the 40s to the 60s, and then from the 80s to 2000. In that in-between period, during the 70s, and also from 2000 to 2010, we were in a secular bear market in equities. During those secular bear markets in equities, they were coincident with secular bull markets in commodities. However, when we had those two secular bull markets in equities, from the 40s to the 60s and from the 80s to the 2000s, those were coincident with secular bear markets in commodities. So we see the same thing, longer-term secular bear in commodities underway. So just want to give the longer-term backdrop. But what this means is that we view these intermediate-term rallies as more trading opportunities than just longer-term buy and hold opportunities. So any kind of rally here, is of a more tactical nature. So what I would say is we're a big fan of using commercial hedger positioning. That's also known as the smart money. And right now they're long copper. So we like to set up here. The names have been pretty bombed out. So any of the Canadian copper names that we look at here, so First Quantum, Hudbay, Tech B, and Lundin. So we especially focus on Tech B and Lundin are the two bigger names. Mm-hmm. Those would be attractive here for any sort of intermediate term rally with upside out into September, October.
Okay. Let's talk a little bit about some of the other commodities. Are there any other ones that come to mind? We've had a big move in the gold price.
Yep.
In my mind, maybe a little bit too far, too fast on that. But any thoughts on your side?
100% agree with what you're saying. So we were bullish, if you recall, back in April. Then we started getting cautious in June. So obviously we missed the move here over the last 2 months. But we're all about reward and risk. And right now the reward versus risk ratio is pretty poor at these levels. Mm-hmm. And the other thing that I would say is that the smart money positioning is extremely short gold here. So they haven't been this short gold since previous peaks that we saw back in, I think, 2018 and then in 2016. So from our perspective, they've definitely run pretty hard here. So we think there should be a good rally as we get into seasonality, probably December through February. Mm-hmm. But don't like the reward to risk ratio here.
Yeah, no, that makes a lot of sense. Let's just switch over to other commodity base in Canada, because obviously we're a rocks and trees economy in particular. So what are your thoughts on the energy complex here?
It's been under pressure for a while. We're very cautious on the space. If we close below 50 on WTI, that means we're going to 40. You can see that globally. Yeah, you can see that globally as well. The energy sector globally has been under pressure and has been a big relative underperformer. So for Canadian energy to get going, you really need international money to come in and move it, and that's not happening. If anything, it's going the other way. It's flowing out. So that's in line with our longer-term bear thesis on commodities. And so we'd be reducing exposure to energy. The pipelines have held in well, especially those names with strong dividends. Those are our favorite holdings if you have to be in the space.
So what do you think that means for the TSX overall then?
Well, that's been our view since, call it 2013, is that the TSX is going to underperform the S&P 500 during the secular bull market in equities because it's got the higher resource weighting, which is going to be a drag. So you can get these periods of outperformance by the TSX, but in general, the longer-term trend is down. Now, what we're saying here, and just to be clear, is that the TSX is going to underperform. So let's say the S&P 500 is up 20% in 1 year, then the TSX will be up 15%. So we're not saying it's negative. It's just that on a relative basis, it's going to underperform.
Yeah, and that's a good point to make to people to realize underperformance is relative to other benchmarks. Yep. Speaking of other benchmarks, can we talk a little bit about currencies? Because we've been seeing a lot of moves all over the place in currencies. Obviously, there's the fears about Hong Kong. There's fears about presidential tweets that seem to come up at any given time. What are your thoughts on we've seen a big move in the Japanese yen. Where do you think things go from here?
So we're long-term bulls on the U.S. dollar in line with the secular bull market in equities. I think that's going to drive everything else. So that means we're cautious/bearish on the Canadian dollar, and we're seeing that as well. So we're around 75 cents. Our technical work suggests next downside target is near 73 cents.
Okay.
And then on the Japanese yen, it's over the last couple of years, it's correlated really well with gold. It's a bit of a safe haven play. Mm-hmm. And what we're seeing is that the setup right now is exactly similar to that of gold, in so much as the smart money was long back in April, but they've pared back their positions quite significantly, and both gold and the yen have had a pretty strong move. So from our perspective, through a technical lens, they both look like they're set for intermediate term pullbacks.
Okay. So, is there anything else that you're seeing out there that investors and my listeners should be aware of that we're going into? I mean, it's summertime right now, so you've got, it tends to get a little quiet now. Right now, we seem to be going through this whole correction at this point. What's on your radar aside from that?
For Canada, the sectors we'll be focused on are insurance, infotech, financials, and industrials. That's where once this, our work suggests that we're pretty close to a low now. And once that low does take hold, that's where we'd be putting money to work into those 4 areas of the market. Perfect.
Hey, well, Javed, really want to thank you for taking the time to share your thoughts with us today. Thanks very much. See you soon.
No problem, Greg.
Goodbye.
Thank you.
Hey, thanks for listening. Don't forget to subscribe and visit us at our website at ggoernert.com. That's greggoernert.com. Thanks again.